Everybody wants to give you their opinion on interest rates, but I'd like to give you some facts. So watch this for some facts and history on interest rates. Here's a chart of long-term rates going back to 1790, so about 230 years of data. And you can see there's only a couple times when rates were really, really low. Post-Great Depression, 1930s, certainly getting into the 1940s. And you can see here getting towards 1950 and certainly into the 60s. This is when rates start to go back up. And then, of course, as you can see here, post-2008 economic crisis, certainly 2010. The bottom was probably 2020, 2021. Chart doesn't quite go there, but mortgage rates were down at 3% or a little bit lower. So there's really only two times in history when rates were that dirt cheap. We got close here in 1900, but you look at kind of the average, somewhere around here I would call the average. So I would say around 5.5%, give or take, maybe 5.5 to 6 somewhere. That's kind of a historical average interest rate, just to put into perspective so you know what to expect with the rate you get, what opportunities you may or may not have with refinancing, what kind of risk you may or may not be taking with an adjustable rate mortgage. I think it's important to start with this data here and seeing that rates don't go dirt cheap that often in history. And it seems like the average is somewhere in here, right around 5.5. Now, here's another interesting chart. These are interest rates going back to 3000 BC. So this is a little over 5,000 years history of long-term rates. And you can see again, the red circles show you post-Great Depression and post-2008 up until 2020, 2021, when rates were so low. That's it. There's only a couple times in thousands and thousands of years that interest rates got that low. Seems like the average is kind of somewhere in here. Again, it seems like around, 5.5, 6% somewhere. Just depends on some variables in the time. Just really good data. Lots of history here, 5,000 plus years, to give you an idea of what to expect for a normal rate and what might be considered low, what might be considered high, and what might be considered average. Now that we've seen these historical charts, let's try and put this data to some good use. First, let's assume that we're getting an interest rate quoted to us that we think is high, 9%, 10%. Well, the charts say that's pretty high. So I think you would respond in one of two ways. One, you would consider an adjustable rate mortgage. Hey, if I'm getting 9 or 10% right now for a 30-year fixed rate mortgage, I don't know that I want that. Maybe I can get an 8% 5-year ARM. I'll lock my rate for 5 years, and then I'm going to hope to refinance, realizing there's still some risk there. Maybe you're not going to be able to refinance. Second thing I would consider is if I'm going to hope to refinance and if I think the rate that I'm getting is high, I'm not going to pay any discount points. Don't do a rate buy down by paying discount points and take a rate where somebody says, well, I can get you 9.5% with 2 points instead of 10% with no points. Take the 10% with no points because hopefully you're going to be refinancing it in short order. Consider all your options. There's risk all across the board. None of these historical numbers are guaranteed, so consider everything. But when you're getting quoted an interest rate that's high, I think those are the couple things you want to consider. Now let's consider another scenario. Let's say that the rate that you're getting quoted is historically low. You're getting quoted 3% or 4%. The charts say that's pretty low. I think you take a 30-year fixed rate and you're done. Now, depending on how long you plan to be in the property, maybe you pay discount points, maybe you don't. To me, that doesn't matter as much because the money's cheap to begin with. Whether you get a 30-year fixed rate at 4% with no points or a 30-year fixed rate at 3.5% with 2 discount points, the charts say that's all low. Why would you do an adjustable rate mortgage? If someone says, oh, I can get you a 5-year ARM at 2.75% instead of a 30-year fixed rate at 3.5%, that just doesn't make sense to me. I know some people will say, well, I know I'm going to move out in 5 years, but who knows that? Maybe you keep the property as a rental property when you move out. Maybe you live there yourself longer than you plan. maybe. I just would be conservative. When rates are low, take the 30-year fixed rate and lock it down and be done with it. That's what I would do when rates are historically low. In conclusion, I think what these charts tell us is that you need to take the mortgage interest rate that you're getting quoted and put it into a historical context, and then think about what might be the best option for you. Secondly, I think it's really important to work with an experienced mortgage loan officer, somebody who will take a consultative approach, and instead of just selling you or telling you what you want to hear, consult, educate, show you historical charts, Q&A, really dig deep and go into a deep dive on education on many different topics, not just interest rates, but title insurance, mortgage insurance if you don't have 20% down, loan programs, interest rates. There's all kinds of different things to talk about, dozens of topics really. And then of course also always consult reviews. Not only make sure you're dealing with an experienced lender who will consult with you, but also somebody who's highly reviewed and has proven themselves in the past. Hope that helps. Thanks.